Data out today shows the RBA is keeping rates at 2%. So what does this mean for the Aussie economy? I'm joined by Gavin Friend, market strategist with National Australia Bank, to find out. Gavin, as expected, RBA keeps rates at 2%, with Governor Glenn Stevens saying the policy will remain accommodative while citing weak investment and spare capacity in the economy. Given the weak economic outlook, could we assume that there is a bias towards easing in the near future?
We describe this as a soft easing bias. It's not explicit. There's a willingness to ease if required, but with no immediate intention to ease, I think is the way we'd see it. It's not explicit, but there's an intention to move if the data suggests it. Now, we know that Australia, the economy there is growing below trend. This year, likely to see something like 2.3, 2.4% versus a trend rate of just above 3. We know that there's ample spare capacity, and there have been, for instance, no wage rises for several years there. Last week's Q1 capex numbers fell more than the consensus and ourselves expected, down by 4.4% on the quarter, with declines pretty broad through mining, not just mining, but also manufacturing and other sectors as well. And so today the RBA built on this, built it into its statement, saying that the key drag is business capital expenditure in both mining and non-mining sectors. We do need to acknowledge, though, that there is ongoing capital expenditure in other areas like healthcare and education, and other sort of more high-profile or high-frequency data such as employment, household spending, are growing more positively and obviously adding to growth in the economy.
The Australian dollar has declined noticeably against a rising US dollar over the past year, though less so against a basket of currencies. Will further depreciation be likely?
Yeah, you look at the Aussie, it's come down about 20% since July last year, which is really consistent with all major currencies versus the dollar. If you look back from the cycle highs, the Aussie's down about 30%, but as you point out, against the trade-weighted basket, it is less than that, sort of 13, 14%. But it's still a significant decline. Clearly, the RBA and economic forecasters such as ourselves think that the economy could benefit from a lower Aussie. The RBA makes no secret of that, and we saw in today's statement that they suggested again, they kept that line in there, that it's both likely and necessary that we'll have a lower Aussie dollar. And really, we know that for all that kind of talk, what really matters in driving the Aussie will be what happens to the big dollar, the US dollar, as with all things in FX. And there we have the Federal Reserve in the US making it very clear, been very consistent in the last few weeks, that it's trying to get its ducks in a row to make sure markets understand that a rate rise is coming this year. It's just a question of which month. When you look at that and you look at what's coming through in the US economy, with the numbers that we're seeing at the moment do suggest that Q1 in the US was a weather affected, West Coast port affected, and perhaps some evidence of residual seasonality going on there, and that things now, the numbers we're getting at the moment for May, are starting to look better. We've had housing starts going up. We've had, yesterday's manufacturing ISM was solid. We're looking for a pretty decent print with non-farm payrolls on Friday, and tomorrow's trade balance should be much more improved. These kinds of things will just instill in people, in the market's mind, that the Fed is ready to pull the gun on this at some point in the coming months, and that should be dollar positive. And that's why over the next year we have a positive US dollar profile against all the major currencies, including the Aussie dollar. And so from current levels at the moment, we're looking for the Aussie to go down to the low 70s over the coming months. So Glenn Stevens should be happy that, from that point of view, things will be helping them out. So it's a good point for them. They're talking the Aussie down. The RBA is acting, and at the same time, the big US dollar seems to be going up.
A couple of data releases this week, notably GDP growth rate data tomorrow. What are you expecting from these releases?
Yeah, so I mean GDP tomorrow is the big one really. Q1, of course, Australia, like New Zealand, they're at the back of the queue in terms of the running order of these things. China released their Q1 data almost 2 months ago now. The UK and US have had their first and second revisions, so it's kind of historical in a way, but it's nonetheless important. Now the consensus for GDP is for 0.7 Q on Q. The range from the economists in terms of what they're looking for is from 0.3 to 0.9, so it's quite a wide range. We have 0.7. I mean, we were thinking earlier on in the week on the back of the on the capex numbers that there was a downside risk to this, perhaps the 0.4, 0.5. But when you saw the trade numbers that we had today, which were the terms of trade numbers which were solid, and are likely to add something like 0.5 percentage point to GDP, and you looked at the numbers we had yesterday from company profits and inventories, those things should add to it as well. So that underscores our view, and we had an initial forecast of 0.6 on the quarter. We've now raised that today on the back of the export numbers to 0.7. So we're fairly confident, that we'll get a reasonable number from that. And that said, that might give the Aussie a little bit of a kick higher heading into those US trade numbers tomorrow. So that's going to be the focus over the next couple of days.
That's all from Gavin and myself for now. Thanks for tuning in, and be sure to keep clicking back. Bye for now.